2 days before Tim Cook's final earnings call, Apple touched $5 trillion. 48 hours later, $370 billion was gone. And what Wall Street punished them for was the exact same thing it had just rewarded. Apple's stock lost over $370 billion in value on July 30th, 2026, the largest single-day drop for any U.S. company that year. Just 48 hours earlier, Apple had crossed the $5 trillion mark, briefly overtaking Nvidia as the world's most valuable public company. The timing could not have been more jarring. The company had delivered a record June quarter revenue of $109.4 billion, beating Wall Street's expectations. Yet, as trading moved into after hours, shares slid over 6%, closing at $311.25, and the market's reaction was swift and unforgiving. The sell-off landed immediately after Tim Cook's final earnings report as CEO. Cook, set to become executive chairman on September 1st, signed off on a quarter that, by the numbers, should have been a victory lap. Instead, the market's rapid reversal turned Apple's headline triumph into a cautionary tale. In a matter of hours, the logic that had rewarded Apple's restraint flipped, and the company's final days under Cook became a case study in just how quickly Wall Street can change its mind. Amazon stock delivered a 13% surge after releasing its earnings, a move that stood in sharp relief to Apple's swift decline. The catalyst was clear. Amazon's cloud division, AWS, reported record growth, and the company's expansion into custom AI chips drew investor enthusiasm. That same week, Microsoft shares jumped 15% on the back of robust cloud revenue and its own investments in AI infrastructure. Together with Meta and Alphabet, Amazon and Microsoft outlined capital spending plans that put their combined 2026 outlay between $720 billion and $745 billion. This figure dwarfs past years and signals a new era where market value is closely tied to the scale of AI and data center investment. The message from Wall Street was unmistakable. Companies willing to spend big on AI infrastructure were being rewarded, while more cautious approaches faced skepticism, regardless of headline profits. Investors who had celebrated Apple's disciplined spending just days before now began to question whether that caution had become a liability. The market's attention snapped to the underlying details. Services revenue, long considered Apple's highest margin engine, fell short of expectations at $30.74 billion, about $500 million below consensus. That miss, though modest in absolute terms, carried outsized weight, as services had become the company's main source of profit growth and a bellwether for future earnings power. At the same time, Greater China revenue came in at $18.8 billion, falling nearly 4% short of forecasts and raising concerns about Apple's grip on one of its most important markets. Management's forward guidance only deepened the unease. Apple projected September quarter revenue growth of 9 to 11%, a step down from the 16% jump just reported and below what analysts had penciled in. Tim Cook and CFO Kevin Parrick cited significant supply chain constraints, especially in advanced memory chips, and warned that foreign exchange headwinds would further drag on results. In a market now obsessed with AI momentum and aggressive infrastructure investment, Apple's more measured approach was reinterpreted as a sign of lost edge. The same restraint that had been praised at the $5 trillion peak was now seen as a warning flag, as Wall Street began to judge Apple not just by its reported numbers, but by the speed and scale of its AI ambitions. Tim Cook's final earnings call as Apple CEO arrived with a weight few leaders ever carry. Over 15 years, Cook guided Apple from a $350 billion company to a peak near $5 trillion, an expansion that rewrote the rules of scale for global business. This last quarter, instead of a crowning moment, delivered a sharp contradiction. A record-breaking revenue report immediately undercut by the largest single-day market value loss in Apple's history. The abrupt reversal did more than rattle shareholders. It cast a shadow over Cook's closing chapter, turning what should have been a seamless handoff into a public stress test for Apple's next era. John Ternus, soon to become CEO, steps into the spotlight at a moment when investor confidence feels newly fragile. The questions raised by this quarter about growth, risk, and the price of caution now land squarely on Ternus's desk, with Wall Street watching for his first moves. John Ternus inherits a crossroads for Apple, each path shaped by the market's fixation on AI investment. One scenario sees Apple breaking from its tradition of caution, with Ternus signaling a surge in AI capital spending. His first earnings guidance becomes the earliest clue. Will Apple chase the hyperscalers and risk its margin discipline for the promise of AI-driven growth? Another possibility is continued restraint, relying on a rebound in fourth quarter services revenue and signs of stability in China to reassure investors. Here, Apple bets that strong September quarter numbers will quiet doubts, sidestepping the AI spending race. A third outcome emerges if the anticipated AI returns fail to materialize. In that case, Apple's caution could be rewarded, its balance sheet intact while rivals face the consequences of overextension. Meanwhile, Amazon's future depends on whether its chip expansion and cloud infrastructure spending translate into lasting gains. The upside is clear if growth keeps pace. The risk is that heavy investment becomes a drag if enthusiasm fades. The milestones ahead, Ternus's first guidance, fourth quarter services results, and hyperscaler CapEx disclosures will define the next chapter in the race for AI leadership. Market logic now rewards bold AI bets over discipline. Tim Cook's final quarter exposes how quickly leadership narratives can flip. For Apple, the next chapter is written in real time. What's your take?